And we're now live here on our YouTube channel. It's our daily show we call the Halftime Report, where we go through these markets one step at a time, looking at the technicals, talking about the news, individual companies that are in the news, pretty much anything that we think is important and relevant to break down your daily routine and make it easier for you and more efficient as a trader. And welcome back, hashtag Team Tackle in the chat as we're starting our conversation. All the veterans, always love seeing that. It always starts the show on a great positive note. And if you can give me a thumbs up down below, it does help our analytics get more people eyes on this show so we can help more people understand the markets a little bit better. And by the way, brand new subscribers, great to have you. We're pushing over the 18,000 mark this last month, on our way towards that 20,000 level. If you've not yet clicked that subscribe button, please do. Down on the bottom, we do this kind of content each and every day whenever the markets are live. Let's bring in the coaches here from Tackle Trading. We got a full panel like we always do on a Thursday. Got Coach Greg Old Money Holmes, who's going to be breaking down markets with us. Also has got 3 stocks for his segment he does on Thursdays called Buy One, Hold One, Dump One. And I believe we're going to be featuring some stocks in the healthcare sector. Greg, how you doing today, sir?
Doing well. Thanks for asking.
It's great to have you. And Coach Tyler Craig, the architect, joining us for another day in a row here to analyze these markets. Post-Fed meeting now, Tyler. A lot to unpack here today. So quick pleasantries. How you doing, sir?
A lot to unpack. Yes, we finally got something to talk about. So let's do it.
We're going to do it. Maddie, how you doing, sir?
I'm confused. No, I kid. I'm doing fantastic, Tim. I'm excited to be here with the team to kind of break down all the news that has transpired over the last 24 hours.
Let's get down to it. We'll deal with the technical response here in just a minute. Matt, obviously the news of the last 24-hour cycle, as we ended the show, Federal Reserve policy statement did come out in terms of the official statement right there at 2 o'clock Eastern. They held rates unchanged, right? They didn't do anything with their bond purchasing programs. The language in the statement was a little changed actually, but there was quite a few different hot takes from the marketplace. The markets have reacted here, especially after the press conference and some of the things Jerome Powell said. What's your read on what happened with the Fed here in the last 24 hours? Are the markets reading it correctly? What's your analysis?
Well, I think the most important thing is the market just finally broke out of that 9 EMA ride it's been enjoying at Disneyland over the last few weeks. So there's that. But in the market, obviously, we're talking about the central bank and monetary policy over the last 24 hours. And just to give an update to the community, yesterday, the Fed came out with monetary policy. They did not make any changes in terms of the short-term rate, the overnight rate that they lend to the banks. And so the interest rate really kind of just maintained at the same rate. Powell also talked about not changing anything regarding quantitative easing, the $120 billion that we're supplying to the banking system on a monthly basis. But what was interesting in that is that it does look like it's confirmed that the tapering process will be announced. Now, these are kind of where it gets confusing a little bit for a lot of market participants, that they're not ready to begin tapering yet. They're not even ready to begin the discussion of what tapering means yet, meaning they're not supplying guidance towards their tapering. But what was interesting and important to a certain extent with the market is that they are indicating that tapering announcement will be made at some point, either at Jackson Hole in August or at one of the central bank policy updates in the near future. And so we probably will start to see some guidance on the tapering process. And the most likely scenario with tapering will be a redo of what we did in 2013 through 2015. And if you guys will remember, in quantitative easing 1, 2, and 3, quantitative easing had a stop out date. On that stop out date, the market puked up 12%, guys. Quantitative easing 2 had a stop out date. On that stop out date, the following couple weeks, market went down another 12, 13, 14%. The Fed learned from that. In 2013, when they announced quantitative easing, they also announced when they started ending it in 2015, instead of just a stop out date, what they started doing is tapering it. And they started reducing per month $10 billion out of the $85 billion they were supplying to the market. So every month it would go from 85 to 75 to 65 to 55. And so you're most likely going to see guidance that is very simple. That is simply very similar to what we went through in 2015. And so that guidance, the market is now seeing that is starting to come to the market, most likely in Jackson Hole when all the central bank gets together in August, or maybe in the meeting in September. And so the market is behaving like we are going to get that guidance, and that the tapering process will be announced at some point in the near future, which with the most likely occurrence tapering not to begin until most likely 2023. And so everything that's happening right now is kind of that, well, we were projecting 2024, now we're kind of projecting 2023. And that also goes in line with what we saw in the dot plot as well. In the dot plot, which is the projection of all the voting members at the Fed of where they see long-term interest rates, in last year, we had about 3 of the voting members of the Fed suggest interest rate increases that were before 2024. In March of this year, when we saw the dot plot, which was the last time we saw the dot plot, 7 of those voting members saw interest rates increasing in 2023 versus the 2024 expectation. Now we're looking at about 13. 13 voting members of the Fed are looking at interest rates increasing in 2023, and that would be the projection of 2 interest rate increases in 2023 versus where we were expecting in 2024. The last thing that we saw yesterday was they updated their inflationary expectations or guidance by the end of the year. They were looking at a 2.1%. They updated that to about 3.4%. And so a very big increase in inflationary expectations at the central bank, a slight upgrade, a slight update to where their guidance is from a dot plot perspective, and the tapering process most likely will be announced either in Jackson in August or soon thereafter.
Well, and even that, I mean, the Fed is long-term indicated they're going to continue to keep support as long as they feel like they need it, and all those kind of things.
They were extremely patient in their patience language yesterday.
Yeah.
And so, and even Jay Powell said regarding a question regarding the dot plot, take it with a big grain of salt. And just let me tell Jay Powell publicly, I take everything you say with a big grain of salt.
It's implied, bro. You don't have to say it.
You don't have to tell us.
Obviously, appreciate the breakdown, number one, yeah. Matt. Tyler, what was your reaction to the Fed information here in the last 24-hour cycle? Obviously, stocks have had a little bit of volatility. Certain sectors are taking it on the chin. There's action in the metals market and currency markets, but just in general, from Fed messaging and their statement, what's your read on it?
Well, so I take my read from how the market responds, right? Like that's the lens by which I interpret what happened. And there's no doubt, if you look at the S&P today, meaningless. S&P tells you nothing about what's actually going on. So this negative 0.36 is nothing. The headline, and I mentioned this in the pre-show, inflation is deflating. Today, post-Fed yesterday, you're seeing massive moves go on in some major markets, which is probably having some people scratch their heads. I think a good visual, I thought about this as you guys were chatting. You ever play chicken? I'm sure, Tim, you did this, right?
As a kid, yeah.
Yeah. So
not like last week. No, I haven't been running my car at another car and seeing who will turn and swerve. But go ahead.
I feel like we've been in a game of chicken where one car, by the way, this is 2 cars going at each other, where they will crash unless somebody blinks and moves. And you're the winner if you don't swerve out of the way, right? So I feel like in one car you have Jay Powell with transitory emblazoned over his head and on the hood of the car saying inflation is transitory and it is because I said so. And then in the other car you have commodities, which have been flying high, and you have inflation. And so it's like, well, either it is transitory and commodity prices are going to cool off, or it's not, and we're all going to die because you guys are going to run into each other. I feel like yesterday and today, inflation swerved. And they're like, okay, fine, transitory, you win. And so the market suddenly, for whatever reason, has said, okay, fine, we'll price it in so it's transitory. You said it. you win. And so you're seeing money come out of commodities today. You're seeing the dollar strengthen. You're seeing interest rates go back down, which is not what happens when inflation is a concern. And as a result, you're seeing massive rotation out of areas that you would expect to do better in a weak dollar, rising interest rate, inflationary environment. Money's just flooding out of those trades today.
Well, and honestly, guys, you're seeing a quicker rotation in terms of sectors, but we were already seeing that a week ago, 2 weeks ago. And so what happened, it kind of exasperated that rotation over the last 24 hours. And so it's almost like the market heard what it wanted to hear and then just started doing what it was already doing in the first place, rotating out of commodities, rotating out of industrial, rotating out of the cyclical areas of the market. When you look at the last couple of weeks in the marketplace, we've seen money come out of cyclical. We've seen money go into growth. We've downgraded cyclical areas of the market. We've upgraded growth areas of the market over the last 2 to 3 weeks. And then even yesterday, you started seeing a little bit more confirmation there. And so the market is behaving like the inflationary situation was cured in the last 24 hours. I think that's a bad take, by the way. Mm-hmm. But the market is acting like that because the market is now signifying that we are looking at the end of tapering at this point. We are looking at interest rate increases at some point, right? And the market is basically saying, well, this is the Fed looking at finally normalizing the situation, which will eventually cure the inflationary situation, which would therefore lead it to be transitory. I'm not sure that logic holds water, quite frankly, right? And again, even based on what Jay Powell said yesterday, take the dot plot with a massive grain of salt and look at their inflationary increases across the board. I think more than anything, what you saw yesterday was the continuation of what we have been seeing in recent history from a sector rotation perspective, but you also specifically in commodities, guys, because that's where we're seeing the biggest price movement, right? Gold, copper, the metals markets, right? That's where we're seeing the biggest. It wasn't just yesterday, the central bank guys. You had a big story coming out of China that China's cracking down on specifically inflation and metals, and they are now increasing the supply quite a bit, actually, to the marketplace to drive down the prices of commodities as well. And so you've had this sector rotation happening over the last couple of weeks, subtle, but you have seen sector rotation over the last couple of weeks. Mm-hmm. That gets exasperated a little bit yesterday. You have the double whammied Chinese response to specifically precious metals and inflation. And then you have the update to the dot plot and the tapering situation. And it was just the combination of, wow, it's not like inflation got cured, but you got the two biggest countries in the world targeting inflation now. Mm-hmm. And the market is saying, finally, countries are waking up. And you're also seeing on the backs of other countries increase interest rates over the last couple of weeks as well. And so you're starting to see the philosophy build that, yes, it's a little bit of a joke that people are thinking inflation is cured, but at least governments around the world and central banks around the world are actually accepting the fact that inflation is concerning. And we're starting to see we're starting to see some actions taken to fight that inflationary situation. And so the market's really pricing in belief right now more than anything else.
Greg, let's get you in here on this conversation as well. I mean, what's your read on the situation? You know, what the Fed did yesterday, their messaging to the market response.
Yeah, I found it interesting that they changed their own inflation projections. That ticked up. And then they turn around and basically say, yeah, don't worry, we got this. Right. You know what I mean? That's kind of how it felt to me.
That's how I read it.
I feel like there's a massive overshoot on what they can do and what they've said, right? So there's this big reaction in the commodities, and even with all the stuff that Matt talked about, the China, flooding the flooding the metals markets, whatever they're choosing to do. All of that seems like a really knee-jerk kind of, we've got this kind of scenario, and I just personally myself, I just don't buy it. I think the Fed since 2008 has been kicking the can down the road. I don't personally see that they've got a great handle on it. I understand what they're saying. I also even understand kind of to a small degree, the market's take on it, but I just think everything seems to be an overshoot. Even if they did the interest rate hikes right now, I still don't think you can stop inflation on a dime. Like that's not how I understand how it works, at least in my limited capacity. So, like I said, I kind of see an overshoot in reaction to the metals and things, the commodities in general. I see an overshoot in that. I see an overshoot in the market's acceptance of what they're saying. Like, as Matt put it, and we've been talking about this every Thursday since I've been on here for a while. They're just talking about stuff, you know what I mean? And now they've just said, okay, well, 3 years from now we were going to do something, we might do it 2 years from now. Like, it just doesn't, I don't know. I'm more of a concrete type guy. I like to see things that make sense, and it doesn't hold a lot of water for me right now either.
The Fed raised their inflationary expectation from about 30%, guys, from 2.1% to 3.4%. If the Fed raised interest rates twice yesterday and ended quantitative easing, I'm not sure that projection wouldn't be hit anyways.
Mm-hmm.
I think
and that's the reality. And so I'm with Greg here. I'm looking at the inflationary situation. I'm looking at the economic situation. I'm looking at what governments are doing around the world. And I'm just wondering at what point they're actually going to do something. Because we're still just talking about hypothetically discussing at some point taking action. But I'm just going to leave it at this. And I want to ask you guys one simple question. How many times since 2008 has the Fed's dot plot been accurate?
I can't remember one. I mean, you and I talk about this all the time. I don't think there's been one.
Not only has it not been accurate, it's not even been in the same, like we'd like to put it, it's not even in the same ballpark, right?
Mm-hmm.
You're not in the same universe regarding the accuracy of the dot plot regarding where they expect the interest rates to go in the future versus where they actually transpire when that future happens. Mm-hmm. We're talking off 2-3%, guys.
I think Matt makes a great point.
The EIA numbers are more accurate than the Fed dot plot is.
Says a lot.
No, he did.
I think Matt makes a great point though too. If the Fed is saying that they're going to raise from, what was it, 2.3 to 3.1? What was those numbers?
Inflation
2.1 to 3.4%.
Right, 2.1 to 3.4. If they're saying that's the inflation that they're seeing, and the way that they calculate it, I guess for me, I'm like going, well, what is the real inflation out there? You know what I mean?
Exactly.
Because they don't calculate it the way a normal human being would calculate it.
Well, so they got they got their math. They got Fed math, Greg.
Yeah, exactly. That was my whole point is, there's an overshoot to all of this, right? So yeah, they're saying, okay, yeah, we're seeing inflation tick up a little bit. Well, the public at large would see quite a bit of an overshoot beyond even that, I think. And so I don't think you can stop that. Like, I don't know how much you guys know about trains, but I see coal carrying trains go by my place every now and then, and those guys can't stop on a dime. And that's kind of how I see inflation. Like, I don't think you can just put up a cow catcher in front of it and call it a day,
Last question I got for you guys.
Okay.
Last question I got for you guys on this. Between now and the Fed's projection of 3.4%, the Fed is currently going to do nothing to stop that.
Yeah.
Correct?
Mm-hmm.
Like, we're not increasing interest rates in the next 6 months, correct?
Nope.
We're not tapering in the next 6 months, correct?
Well, they might talk about it in September.
But we're not doing it.
No.
Okay, so at no point in the next 6 months will we do anything to stop this inflationary situation, correct?
It doesn't sound like they have any chance.
In 2022, we do not know yet what the Fed's projection on inflation is, but I'm willing to bet it's going to be an increase since we're not doing anything right now to stop it, correct?
Mm-hmm.
So all through 2022, we're going to still pump in $120 billion in QE, correct? And we're still going to maintain a zero interest rate policy, correct?
Correct.
So between now and the end of 2022, we're going to see a pretty fairly sizable increase in inflation, correct?
Mm-hmm.
But yet in 2023, 2 interest rate increases are going to stop that?
It's a snowball rolling downhill.
Come
Some kid in a snowsuit's going to get
guys,
bowled over.
we have
That's
too much
us.
money. Today, we have too much money in our banking system. Today.
Mhm.
2 years from now, as we do
Still
nothing to change that, it's going to be worse. I have a hard time believing that if the Fed is going to increase their own inflationary projections by over 30% in such a short time period, that 2 interest rate increases projected 3 years from now would stop that. It's a hard sell.
It's hard sell for me as well, and obviously, that's why we're taking the commentary from Jerome Powell with a grain of salt, and we're not really buying a lot into it. Let's talk a little bit about the market response here,
Yeah.
Tyler, and let's break down the technical response now. And by the way, appreciate all the insight and the commentary, guys, because that is what the markets are talking about. I think that was very valuable. Tyler, what are we seeing in the technicals then? I mean, the S&P, like you said, nothing burger, pretty much sitting here on a doji. There is some action in certain sectors, and obviously commodities we got to take a hard look at. So give me a rundown if you can.
Yeah, I mean, if you want to know why the S&P is able to be with a doji today, given the bloodbath you're seeing in certain areas, it's because of what we just say every flipping time. It's rotation. It's not mass exodus out of everything, right?
Mm-hmm.
This would be a completely different story on the S&P if these are all the sectors that we track in our weekly newsletter. But look, half red, half green, doji. Okay, that makes sense. I mean, you're seeing money flee energy, financials, basic materials, industrials, but it's going into tech, utilities, healthcare, some other areas. So it just doesn't tell you the right story, right? Or it's somewhat misleading because you would think, oh, what are you guys talking about? It's a doji. But I mean, I guess, Tim, it could have been a lot worse today. I mean, I know people that are in commodities and these cyclical areas are like, no, it's bad. It's bad. And we're like, I know, but it could have been worse. Like at least on the broad market level, a shuffling of the deck as opposed to throwing all the cards out, right? Mm-hmm. But if I go to the other end, so I don't know that there's much we need to say on the S&P. The story is these other indexes.
I agree.
Yeah. So as far as that goes, though, if you want a silver lining, you go look at the NASDAQ. Thank goodness that you're seeing strength out of tech continue. This is what Matt mentioned earlier with growth coming back, seeing some rotation into tech, right? That has been the case for a week plus. It just accelerated. Everything accelerated today. To Matt's earlier point, the Fed response exacerbated those trends that were already in place. So strength out of tech today, that's where you're going to see the most, I think, opportunity. It'll be interesting to see if that's a one-day deal or if it just continues the trend. I'm hoping this is, a multi-week, multi-month type thing because there's a lot of interesting patterns in tech. But that's your silver lining if you want one for today is what's going on in tech.
And the one thing I'll add to that, Tyler, and thank you for that, would basically be the anatomy of a bull market. And every time I see volatile days like today, right? You always want to understand what's happening with the market participants.
Yeah.
And if everything is red, you're concerned because that is let's just run for the hills and not even deal with anything moment, right? Yeah. But what does Tyler always say about the anatomy of a bull market? Money rotates. And as long as money rotates, the philosophy of the bull market is still maintaining and still intact. And again, I just come back to the Fed said a lot in the last 24 hours. China said a lot in the last 24 hours. And I just kind of feel after everything and seeing the market's response to it, that the market simply took what the Fed said and used it as an opportunity to rotate what they were already rotating in the first place. And the combination of China's news on the commodity market yesterday that they were cracking down on inflation and increasing the supply of metals to their suppliers, you combine that with the update to the dot plot and the conversation on tapering, that was enough for the market to say, okay, we're good. We were feeling this coming in. Now we're pricing it coming out. And now let's see if that analysis holds water. If the NASDAQ does maintain its strength above 14K, and as we see kind of those cyclical areas, because it's the bloodbath is in cyclical, guys.
Mm-hmm.
That's where it is, and that's where money was rotating out of over the last few weeks. Does that find some stability in price is an open question I have, and does the NASDAQ maintain strength above 14K?
Well, it's got to be an open question because the technical response is so sharp in some of the areas. We have to wait. I mean, just take a look at gold. If we bring gold back up here, and obviously we're talking about basic materials and energy and so many things that are going to be sensitive to commodity price sell-offs. The sell-off in gold here is very, very sharp, obviously. And Matt, it's not going to change any of our long-term beliefs in gold.
No, of course
no
not.
question about that. And the Fed even just talked about today 3.4% inflation.
I think
this
the
year,
Fed confirmed why you own gold.
That's right.
Okay. But from a short-term perspective, you violated everything here. Like literally, name it, you violated it. The only thing you're kind of holding on from a technical perspective is on the weekly charts. And there is something that could form that's interesting that we need to track over time. And that's that 1750 to now 1770 level. When you're looking at that, that's inverted head and shoulders type analysis. That's reversal type analysis on the long term. But that's obviously going to take some time. And everybody in the gold market today is like, yeah, I get it, but we just violated everything.
Yep.
Right. And that's the concern. So that's going to take some time. But in terms of the violations, we talked about this. Once you started seeing that short-term analysis roll over and that 20-period moving average and Tyler's trend line get violated, the market is rotating a little bit. And we talked about that, a very important test of 1850. And even though you have that, 200-day moving average and the 50-weekly right there as well, once you start rotating over, it's just another straw that breaks the camel's back, guys. Whatever story you want to point to over the last 24 hours, whether it's China or the Fed, it's just the straw that broke the camel's back, because once that weight gets on there, man, 1850 didn't stand a chance, guys. Mm-hmm. It did not put up a fight. The 200-day didn't put up a fight. The 50 didn't put up a fight. This is money rotating, and you have to be patient in terms of letting support find. Don't get me wrong. I'm a bigger believer in the longer term analysis today than it was yesterday. And I was a pretty big believer yesterday, but short-term market participants are going to price things in. And right now, the combination of the Chinese news yesterday and obviously the central bank yesterday, money is flowing out of the metal markets, is flowing out of commodities, not because we don't believe in inflation, guys, but because the governments around the world, including major governments around the world, are signaling that they are going to attack inflation to some extent. And before the last 24 hours, a lot of the market participants were like, okay, inflation is concerning. What's the plan to do anything with it? And so at least now there is some philosophy building. Well, China's cracking down. Central bank is looking to increase interest rates sooner than expected. Europe will most likely increase interest rates sooner than expected. And so you're just starting to see this belief that the governments and the central banks around the world are going to attack inflation to a certain extent. And now you're seeing that price come out of the marketplace.
Mm-hmm. Tyler, anything you want to add to the analysis here from the chart perspective? I like the eye on the weekly. Obviously, that's going to take a long time to develop firmly on a weekly chart.
Nobody wants to talk about that on a day when the last 24 hours, gold got rocked by 100 points.
It's just getting rocked right now. Tyler, what's your read here? What's your messaging?
Yeah, the message I would leave is, if you didn't know how you would manage gold going into this sell-off, today is a really bad day for you to be like, all right, what should I do with my gold position? Like, this is the exact situation why you got to pre-plan your trade, man. Because this is the type of day where you can make some dumb decisions if you didn't have a game plan going into this. And the reality is, if you're a long-term investor, you've seen this a million times. So this shouldn't really change anything. If you're a short-term trader, I hope that you had thought when this was at 1900 what you would do if it rolled over, and acted accordingly. And if you didn't, that's your takeaway. Do it different next time.
Mm-hmm. Greg, anything you want to add to commodities here, just in general with gold? We're going to talk crude oil separately just in a second, but anything you want to add to this one?
No, I go back to my original point. All of this kind of movement seems like an overshoot. The upswing in the dollar, the crack in gold here, it all seems to be a bit of an overshoot. I like the case for gold long term, much like you guys do as well. This is a little more aggressive than I expected, to be honest with you. But you know what? At the end of the day, it is what it is. It's the markets have spoken. We need to listen to them, and I really like Tyler's take there. You know what? You better have a plan for this stuff, right? Because this stuff happens, and it's not like it just happens once. It happens over and over again. So that's really all I see today is an overshoot in several areas.
Yeah. All right, let's flash through the rest of the commodity market here as we keep working through our show. We're also going to get into a little bit of stock talk. Then we're going to play buy one, hold one, dump one here in just a few minutes. If you're out there watching, loving the chat here, as always, guys, participate in there. Feel free to comment, ask questions, things like that. A lot of Team Tackle will be very, very helpful. But let's keep rocking and rolling here. Crude light next, if you can, Tyler. And obviously, it's a little bit of a sell-off here today with the commodities sell-off down 2%. It's had an incredible run. In fact, I think you jinxed it there yesterday, Tyler. You said so many days in a row it was a record that it'd be running up. You open your mouth, and then here we are, Tyler. So
even yesterday was an intraday
higher. That's right. Yeah.
Listen, I will share with you after the show why I'm so much bad luck with the Jazz, but I'll leave that for later.
All right.
You might be able to blame them losing on me.
Are you the jinx?
Tyler, I've been looking for somebody to hunt regarding Jazz.
Oh, trust me. I have not seen any Jazz games for the last 10 years.
You watched the Jazz game yesterday?
Oh, I watched the last three. What's the last three?
You watched the last three and we lost.
Tyler Craig, you are not allowed to watch the Jazz game 6. Publicly, you are not allowed.
After last night, I don't even know if I want to anymore. I'm going back into my hole. I'll see you in 10 years on the whole basketball front.
So you're the reason the entire market is selling gold and the Jazz lost, okay?
Bring on the hate mail, baby.
Are
Come
you
on.
also the problem with palladium here too? I mean,
yeah, how far does this go? How far does the jinx go? I'd like to know as well. Anyway, what are you seeing technically here, Tyler? Obviously, first red candle. That's actually a lower candle here in quite some time. Maybe a little pullback developing, but still an incredibly strong product. What are you seeing here?
Well, this is the least bad of all commodity charts, right? Like a lot of them were taking out support, reversing trend. All this is doing is pulling back from a really good launch. You weren't buying crude oil the last couple of days anyways, because it was extended. This is what you wanted. I'm a little disappointed that they're hitting energy stocks so bad. I mean, given that oil is up and looks the best, I'm a little disappointed that energy is puking it up so much today. But
it's the cyclical as well. Remember,
it's getting caught up.
Money's getting slaughtered in cyclical today.
Yep. Yeah.
Which,
by the way, silver lining is if you think it's a ruse, if you think it's an overshoot, if you think it's an overreaction, there will be opportunities on the other side of this. So,
all right, let's ask the coaches here, specifically energy. Is it an overreaction to the energy stocks based on what we're seeing in the commodity market today? Just a yes or no. We don't need to go deep here.
Yes, yes for me.
I'm a yes as well.
Actually, yeah. I want to say no, but I want to qualify it too. So I'll go with no. Since we can't explain, I'll go with no.
Yeah.
Well, now I got to get an explanation.
Well, now I'm interested in.
Yeah,
okay.
Give me your thoughts, Greg.
So here's my thoughts. You guys say, is it overreaction? I actually been watching the crude oil chart, and I've been waiting for, you miss the pop, wait for the drop kind of thing. So I've actually been waiting for a pullback. Now, how deep that pullback goes is the question. I don't think this is unwarranted, as Tyler did or said yesterday. How many days in a row did this thing go up? So it had to pull back. Obviously, it's getting caught up in the fact that the commodity space is getting whacked. But I don't think this is a big overreaction. Now, if this thing broke that support level down there around 67, that would be a different story as far as I'm concerned. But this to me could be a garden variety pullback.
So we agree with each other then.
Mm-hmm.
We all agree. I think we're all good here on the technical pullback in crude and why crude looks better than the other instruments that's tied to inflation is because of the strength in crude leading into that, which means the pullback is going to find support. The overreaction is in the energy space specifically because crude only came down into support. And so there, from the crude chart, I don't think there's anything there that's unexpected or volatile or crazy. It's the actual energy stocks puking up a little bit of their gains, given the fact that crude is still strong and still expected to, at least for me, I think crude's going to find support here. I think crude out of all the commodities is going to find that tradable instrument a little bit quicker. So I actually think we're agreeing with one another. We're saying that the overreaction is in the energy space specifically because crude itself is still strong.
Sorry, that was my bad because Tyler had the crude light chart up. That's when you were asking a question. That's what I thought you were talking about. Is this overreaction?
No.
Then my answer is yes. So
yeah, that's all I'm saying.
I was looking at crude. He had the crude light up there. I'm like going, that's not an overreaction, but yes, this absolutely.
Agreed.
That's
no. We're good now.
Okay.
It does blow up the potential high base breakout we had there on XLE, though. I mean, short-term technical analysis now is a little bit out of the winds. It's got to develop from here, correct?
Yeah.
Oh, yeah.
Yeah, I mean,
if it holds at 20, though,
that's kind of the kicker for me here because, yeah, a lot of times you want to see especially after volatility kind of increases, you want to give it a little bit of time to stabilize and reaffirm its trends and patterns, right? Mm-hmm. But on a day like today, where I kind of feel we're overreacting a little bit in the marketplace to the news, quite frankly, and don't get me wrong, I feel it's a very important news day over the last 24 hours that we should take far more than a grain of salt like JPAL suggests. But I also think that it's a slight overreaction to what was announced when you actually look at what was discussed versus what the market is actually behaving like. The market is behaving like the cure for inflation was found yesterday. That's not the case. We just started talking about what we're going to be thinking about doing at some point in the hypothetical future over the last 24 hours. And so the overreaction to me simply leads me to believe that the market utilized the last 24 hours as a way to price in certain things they were doing in the first place.
Yeah.
And so for me, it's about seeing the stabilization of charts, seeing gold, quite frankly, at 1750 to 1767, seeing that support level form, looking at energy here, and you said, okay, it's going to blow up that high base. Maybe. But if that 20-day moving average holds and you get a doji tomorrow going into the weekend and you get a positive response coming into the weekend, you're lining that up again. And so I think we need to, as market participants, on a major day like the last 24 hours, we're all going to have a little bit of belief, a little bit of more belief in the market action than in terms of what is actually transpiring out there. So let's just give the market another day or so to really affirm these price movements we're seeing in the last 24 hours. I think that's all we're suggesting is, yeah, we see the price movements market. We know where you're pricing in certain beliefs. Let's now see it actually transpire in terms of the volatility subsiding over the next 24 hours or so before you really look at saying, oh man, that thing is blown up on energy. Maybe, but let's see the next 24 hours first is all I'm saying.
Yeah, I think it's the right prudent approach towards it as well. And, obviously, as we're talking here, commodities, we're going to next talk about the dollar. But
honestly, specifically in the energy space, if that crude chart got blown up like gold, got blown up like platinum, go look at the platinum chart. Go look at the palladium chart. You want to look at an instrument that got destroyed? That got destroyed.
Mm-hmm.
Okay, now go look at the crude chart. I'm seeing an increasing momentum with a bullish retracement into a known support level at 70. So let's see if crude holds at 70, I'm willing to bet energy recovers pretty quickly. So that's all I'm suggesting. There is strength in crude. In the other metal mining markets, there's weakness. So I'm just saying, let's give energy a little bit of time is all I'm saying.
As a matter of fact, one of the most startling visuals I saw all day was when Tyler brought up the FinViz heat map for all the metals markets and all that red, Tyler. It's not just gold. In fact, gold's not even the one taking it on the chin the worst. It is across many, many areas of the commodity market. So this is that broad-based, theme-based response to what the Fed did.
Well, and honestly, in the metals market, this started with the Chinese news, not the FOMC news.
That's right.
And the Chinese news was very, very specific to the metal mining market, not other inflationary products like crude oil or other energy products. It was specific to increasing supply in the metals markets.
Yeah, absolutely. All right, last couple of areas of the market, then we're going to move on. Quick look at the dollar, if you can. Obviously, the huge price response is giving that inverse relationship to some of those pressures as well. I know, Matt, what you've been talking about all day. Do you have the same opinion with the dollar, about patience? Let's see how this thing can play itself out, because this is a huge lift off the last 2 days. Anything you want to add to dollar analysis here while we're...
Well, that confirms that major support level as, man, that's cement is what that support level is at this point. And so that confirms that as an extremely strong, kind of the bottom basement of dollar analysis. And you got to call this as the confirmation off of a reversal.
Absolutely. Yeah, absolutely. Reversal characteristics and nice little blast off there.
Now, in terms of longer term analysis, like if you look at it on a weekly chart, you're going to see net neutrality in the short term.
All right. Last one, Bitcoin. If we can take a peek here, one interesting price response. We're talking about it last because not much. Bitcoin isn't moving at all on any of this stuff. In fact, they're kind of
taking it as a positive.
Taking it. Yeah, that's the way I'm reading it as well. I mean, little hesitation, candlestick here. We've been pushing up towards 40K. I still got it in the long volatile range here, Tyler, until further, kind of information comes out. But what you read here on the chart response on Bitcoin?
Yeah, I think as we said yesterday, in any kind of backing and filling at the top end of the range is constructive. Gap fill also, I think, would be good. But yeah, I think on a day like today, you look at Bitcoin, you're like, oh, at least you aren't crashing Bitcoin. Good job. You are uncorrelated to the other stuff that's getting smoked today. I'm with Matt. I think it's a good omen. Today hasn't changed my outlook at all. I still like this on the breakout over the 41,000. Back and fill up here, it's fine. I would like to have it hold above the 20 MA. I mean, it gets a little bit uglier if it takes out 37.5. But other than that, yeah, just keep holding up here and we'll be just fine.
I'm with you. All right, let's move right into stock talk. And there's only a couple of quick news items, actually, and that grabbed my attention that we're talking about here. I don't know, Matt, if you looked at earnings, but there were not real notable companies in earnings. Two real quick ones I'll just give the detail on. Lennar Home Builder, stock. They cited really good market conditions as home prices are really high in the last, year and a half. Obviously, we've known some of that data, been reporting it now for months and months and months about the rising home prices and home builder expectation. Lennar cashed in on some of that. Nice little rally off of support in a price response. They beat on EPS, they beat on revenue, they beat, and they even said good things about the future here. Tyler, coming off of a support in a deeper retracement, though, is there anything there grabbing your attention from a chart perspective?
Yeah, this is probably where you got to look at the weekly to get a little bit cleaner view. And when you do, this is what I'm talking about. See, on the daily, you're like, I don't know, broke the 50, flirting with the 20. Like, was it too deep? Well, you back it up a little bit and you say, okay. I mean, weekly pullbacks have been buys this whole time. I don't mind this spot on a longer term time frame. So yeah, I think it's interesting to me. I like the relative strength today too. It's ignoring what's going on elsewhere. I also like that it's breaking the 20 MA. So yes, I do think there's some interesting things going on in this chart.
maybe a watch list candidate for something to develop over the next little bit. You got to like the short-term response. I don't think there's a trade there yet. And then Kroger, the grocery giant, obviously that a lot of people know those brand names. They're having a really nice response. Kind of company you love, Greg. They announced a share buyback program of $1 billion. They also put out a bunch of good forward guidance expectations. They had a beat, slight beat on revenue. They'd make so much money, $41 billion against 39. And they had pretty good numbers around their online and digital sales. Greg, this is your kind of company, dividend payer, grocery store chain, rallying after earnings. You got any interest in Kroger here?
Yeah, I actually, full disclosure, I've been in Kroger for a decade or more now. I look for opportunities to pick this up whenever I can. I'm always watching these pullbacks. I'm happy to see this response here. You've got a double top form in there today. I think a break above that, and you're pushing back up to that high of 43 there. So yeah, I absolutely, this company, I don't think you can beat it fundamentally speaking. They sell food and we all got to eat. So, it's good from an investor standpoint, as far as I'm concerned.
It's been a great performer for those dividends for a long time. So I can see why an old Buddy Holmes type would, be invested in Kroger, and earnings response here today. Outside of that, guys, NVIDIA, notable here. Take a look at the strength in NVIDIA here today. Last one from me. They got a price target increase on the semiconductor company over at, I believe it was Jefferies, to $712. They were already below it, and then they're rallying up to $740. They like the company. They said some positive things about it. NVIDIA is breaking out of a high base. Good reminder that obviously nice little news bump, but a good technical pattern can produce a nice response here. Matt, you have any interest in NVIDIA up here that's running like crazy?
Well, we were in the scatter report meeting last Friday, and we were actually looking at NVIDIA, and somebody said, well, where do you think that target's going to go? And I said, what do you expect? Any breakout of 700 goes to 1,000. So we'll see if NVIDIA holds true like Tesla did. But no, you gotta like the breakout here, and you gotta like the high base and the defensive nature of NVIDIA. So tough candle to kind of trigger into now. But you got to like the breakout.
Had a nice move today.
And I had to step away, but did you cover Lennar?
We did. We hit Lennar and Kroger as well. Yep. All right.
Can I mention something on the video real quick?
Yeah.
So remember that the semiconductors are a big part of the NASDAQ, and SMH is itching for an upside breakout. There's some interesting, AMD is another one today that looks fantastic. I think this had some news with Google or something.
AMD looks sexy.
It just, like this is the area where you look at a chart like this and you're like, what's all the fuss about? You big babies, market looks great. It's like, and tech looks fantastic, but
growth looks decent.
Yeah, that's if you want good looking charts, that's where you got to look right now.
I do have interest on Lennar's weekly chart. Like I like the price response on Lennar.
Yep.
Yeah, Tyler was interested in as well. I'm kind of looking at that daily pattern, and I was thinking more of a watch list candidate, because to me, it's kind of have to deal with that $100 price point pivot.
No, I and I'm with you there, no doubt about that. But on the weekly chart, you got to be looking at that as a retracement on the weekly chart, in my opinion. That's kissing off a fairly important support level. Positive response to earnings, mixed guidance. I'm sure you talked about a little bit of that. Mixed guidance, quarterly downgrades, yearly upgrades. But from a raw numbers perspective, a nice, decent beat and a beat with the mixed guidance report. But the positive response to Lennar looks a little better in XHB.
Sure. Yeah, I think there's interest here. I think you stick it on a watch list and you watch for that pattern develop. So I like it. All right, guys, let's move into our last segment here that we play on Thursdays, and that's going to be our buy one, hold one, dump one. And Greg, I've really enjoyed this, quite frankly, because we do so much trading analysis, option analysis. We always do big picture economic analysis. We don't always do fundamental analysis every day, and which is why bringing you in here to kind of highlight a segment where you break down 3 different companies from a fundamental perspective. You find 3 that you like, you kind of present them, and then we get to decide which one we're going to buy, which one we're going to hold, and which one we're going to dump in a little game that we play here. Greg, what you got for us today?
Well, I was looking through the sectors, and I came across XHE, which is healthcare equipment. ETF here. Notice that we're working our way higher, getting back there to a possible breakout scenario there. So showing some strength. XLV's obviously done okay as well. But I just looked at this one and I thought, okay, let's see if we can delve into this and find some candidates that maybe got some, just a combination of fundamental strength and maybe some growth prospects as well. I've been trying to kind of mix in the two with the picks here. So this is a sector I chose to dive into today, and I got 3 picks here. We're gonna start with the big dog, ABT, Abbott Laboratories. So this one here, you're going to see that these are a little different than the ones I've been bringing recently. I wanted to kind of switch it up and give you guys a little more to think about here. So basically, chart-wise, this is a little different than what we've been looking at. Typically, we've been looking at things kind of at the higher end range and things like that. Well, as you can see, we've had a pretty significant gap down here, kind of starting to retrace back up here, running into some of these moving averages here. So the question that you need to ask yourself is, from the technical perspective, is can we move past these barriers? And I'll go through the fundamentals in a second here. So anyway, like I said, Abbott Laboratories, probably a name a lot of folks know. The next 2 that I'm going to give you guys are going to be less well known. LMAT is one of them. So this one here, more like what I've been showing you guys for the last few weeks here, pushing its highs, pretty significant run here. Lower dollar stock here, about half the price of ABT. I'll go through the fundamentals again in a second here. So again, just a little different look technically, but showing some strength here. And then finally, we have X-Ray. So X-Ray, again, little different look here. They've all had a little bit different looks here. So pull back here, trying to find some support, flirting with those moving averages. Overall, nice bullish trend over the last, I guess you got a year chart up here. Little retracement here after hitting a high, looking for some support there on this one. So just 3 companies that are all basically in the healthcare equipment space. I kind of threw that equipment part in there. They have some exposure to that. So I'll run through some numbers here. I will start with Abbott Laboratory, about $112 stock in that neighborhood there. Their dividend yield is 1.64%. They've got 7 years of consecutive dividend increases. They started paying dividends in 1926. Their payout ratio is 51. Now, I'm going to give you the PE for these. There's a couple of PEs here that I don't know are accurate. The place I get them is not always the most accurate. So take that with a Jerome Powell grain of salt. So payout ratio 51%. The PE ratio for Abbott Laboratories is about 35. Okay, we got some sales growth number here. Now, this one's interesting. The sales growth this year is about 13.7% currently. Their sales growth next year is actually negative 0.8. So they're expecting falling sales growth next year. Assets versus liabilities. This is more your fundamental data here. They're sitting on about 72.5 billion in assets versus 32.5 billion in liabilities. So showing a bit of strength there. They've got 7.6 billion in free cash flow, and they've had 4 years of consecutive net income increases. So every year for the last 4 years, their net income has gone up. Okay. So that's Abbott. So next up, we got LMAT. So $60 stock. So again, about half the price of ABT. Their dividend yield is 0.75%. So not crushing the ball, the cover off the ball there, but 9 years of consecutive dividend increases. They started their dividend payments in 2011. Their PE ratio is 35. Or sorry, I apologize. That payout ratio is 35%. Their PE that I have is 50. Their current sales growth is 17.6%, and next year they're expecting 6.6%. Okay, so smaller cap company here. They're about 252 million in assets and about 80 million in liabilities. They're sitting on about 36 million in free cash flow, and they got 2 years of consecutive increasing net income.
Okay.
All right. And finally, our friends at X-Ray there, about $65 stock in that neighborhood. Their dividend yield is 0.67%. They've been paying dividends, increasing for 9 years now. They started paying dividends in 94. Their payout ratio is the same as Abbott Laboratory, is at 51%. Now their PE ratio, and this is the one that I think might be a little out of whack, their PE ratio I found was 83. So that one, again, like I said, the data I get is not always the best. So current sales growth, 27.1% sales growth this year, and expected 5.2% next year. Assets versus liabilities, they're looking at about 9.3 billion in assets versus 4.3 in liabilities. They're sitting on 600 million in free cash flow, and they have 0 years of consecutive increasing net income.
All right, so let's go through these three and kind of talk about them a little bit, because this is an interesting one here, Greg. You know, sometimes you bring companies that are very, very similar, obviously in pattern and also trend, as well as some of the fundamentals. This one, we've got a little bit more of a puzzle to unpack here, Tyler. I think Greg is trying to make it a degree of difficulty a little bit higher here for us, having some fun with that. So let's talk about these three companies. And Tyler, if you could bring up the data a little bit while we talk about them as well, or unless you want to look at the chart and then bring up the data. Either way, X-Ray, it's a $14 billion medical instrument and supply company, right? Like you talked about, Greg, you know, they've got some interesting chart patterns in that regard. Dividends started in 1994. Tyler, what other detail do we have on X-Ray there? That just go ahead and read that out for me.
Yeah, so X-Ray, I'm sorry, did you cover the first couple yet?
No, we haven't coveed the first two. Just
all right, so $65 stock, dividend yield 0.67. So the lowest dividend yield of the three, increased 9 consecutive years. This is years, right, Greg?
Mm-hmm.
Yeah.
Started paying in 1994, pays out half of its earnings in dividends. PE ratio, if it's correct, is pretty high at 83, but got a high growth rate to help back that up. So 27% this year, 5% next year. Pretty big discrepancy.
Mm-hmm.
Assets 9.3 billion versus 4.3 billion in liabilities, sitting on 600 million bucks, and has not increased income multiple years. Which Greg, I assume part of that's the whole 2020 COVID crap, Jack, and that freak up, right?
Yeah, that one there. When I looked at the data, they basically go. Net income increases 1 year, and then it falls off the next year, and then it increases the next year and falls off. So when we look at consecutive years of increasing the net income, that one fell short.
Can that be a function of just being a smaller company, not as mature, not as able to?
It very well could be. It very well could be. Like you'll notice here, like Abbott Laboratories is obviously the one that everybody would be familiar with. And
right.
Their numbers are very different. What I was trying to get here was just to get three kind of in the same space. Some more established, obviously Abbott Laboratory, some a little bit newer, as you can see here, like LMAT's pretty new, from a dividend perspective and things like that. So just kind of trying to mix it up a little bit there. Yeah, that particular company, they make money, right? They've done okay in that respect, but it doesn't seem that they are as consistent as what the other two have been here.
Mm-hmm. Right. Now, with this one here on X-Ray, what's interesting, because I don't know this company that well. I haven't traded it. I can't remember a single time I have, quite frankly, but I have seen it before. So I knew about this company. It's obviously a $14 billion large cap medical device company. Do you know what they sell? They sell dental equipment, dental products, dental machinery, dental surgery equipment, stuff like that. You know who didn't go to the dentist last year? A lot of people who couldn't go to the dentist last year. So they're big. In fact, they had a revenue drop of about 25-30% over the course of 2020. And that does make sense with the pandemic and restrictions and all that kind of stuff. Their PE ratio at 82, it's a startling big number, Greg, but that, to me, there's context there. Their forward PE ratio based on earnings the next 12 months is only 20, and their historical PE ratios are nowhere near the 80 level. This is not a growth company. This is a value company that pays a dividend. Just had the price of the product, price of the company is still very elevated while earnings decreased over the last year. So it doesn't mean I'm going to buy it. I just wanted to give you some context there because I just dug into some of these numbers. Yeah.
Makes
dental
sense.
supply company. All right, what about the second one?
Now,
All right,
let
so-
me, sorry, Ty, give me one second. So I want to say that, the numbers, the revenue numbers that have dropped for them last year because of the pandemic, if you look back I guess it's 3 or 4 years ago, they also had a drop there. And that's kind of where, they can't use that pandemic as the excuse back in 2016 or whatever it was.
Mhm.
So they kind of have an upswing in net revenue and then a drop. And now the other part of that is that could be based on the business that they have, right? They sell equipment for dentists and things like that. Maybe their customers are not buying every year. Maybe they're buying it on a certain yearly basis or bi-yearly basis, something like that. So that could, again, obviously their numbers could have fallen because of pandemic last year, but it also could be a cyclical type business in that respect as well. So
Gotcha.
just
So
to throw that point in there.
Gotcha. What about LMAT and Abbott? Ty, give us some just a quick run through of the numbers that Greg gave us, so we can start to make a decision here. I've got a little puzzle on my hands here, Greg. I'm still thinking through this one. So go ahead, Ty.
Yeah, LMAT $60, 0.75 dividend yield. So, as far as LMAT and X-ray, those are two pretty comparable. Dividend increase number of years is also the same. LMAT started paying in 2011, pays out a little less of its earnings in the form of dividend, 35%. PE ratio at 50. I'd be interested to see if there's context around that one too, Tim. Sales growth pretty high, 17.6% this year, 6.6% the next year. $252 million in assets versus $80 million in liabilities, $36 million in free cash flow, and 2 years of net income increasing consecutively.
Mm-hmm. Yeah, they sell a lot of medical devices, surgery type stuff for blood vessel surgeries, embolectomies, it looks like catheters, stuff like that. So medical device company is going to be sensitive to how many people do surgeries. Forward PE ratio is still 42 ties. So this is a growth company. It's $1 billion. Instead of a $14 billion company in the X-ray. And Abbott Labs, obviously the juggernaut mega cap, a huge company at $200 billion market cap. So LMAT is definitely that small cap growth company that has increasing sales numbers, but a high PE ratio. That's just the fact.
Yep.
Yeah.
Yep.
Yeah. And then Abbott, obviously the juggernaut. Most people should know that name. If not, they're a huge name in the sector. But what are we seeing the numbers there, Ty?
$111, dividend yield 2 to 3. It's 2.5 times the other two. This one, anyways. Over double the dividend yield. 7 years of increasing dividends per year. Obviously, been around a long time. Started paying dividends in 1926. Pays out half of its earnings in dividends. 35 PE ratio, 13.7% growth this year. That's interesting too. Negative next year. I wonder if they're just pulling forward earnings growth to this year or something. But assets versus liabilities ratio is good, 72.5 versus 39.5, and that was billion, correct, Greg?
Mm-hmm.
Yeah, that's right. Yeah.
7.6 billion free cash flow, which is a lot, and 4 years consecutive net income increases.
All right, let's play the game, where we get to give our assessment and then Coach Greg gets to tell us why we're wrong. Generally is how it's been going lately, but that's okay. That's part of the fun in it. Let's play the game here and let's break them down one at a time. Tyler, I'm making you go first. I think I know where I'm leaning, but I want to hear your logic. Which one you buying, which one you holding, which one you dumping?
Yeah, I think the hold is, in my mind, is easy. I think Abbott's the hold for a couple of reasons. Number one, the longer I look back, the more I like this company. They haven't always been a large cap. They became a large cap over time because they executed well and had a good business. Look, I like the long-term chart. I feel like this is the most stable of the bunch. And if I'm going to hold something, I don't see any reason to sell this, I guess. Right? I don't see any reason to sell this. And if I already own it, I'm holding. And I think the buy is a little more interesting on the other two. So I'm a hold on Abbott. Also has the highest dividend yield. So you're getting paid the most for holding it from a cash flow perspective. PE ratio is the lowest of the three. So, holding something that's lower on the valuation scale, I think is an easier decision to make as well. So then it comes down to LMAT or X-ray. Which one do you buy? And by default, they got to sell, the other one. That X-ray chart is quite volatile, and both up and down, right? I don't mind upside volatility. It's the downside volatility that I really don't like. I just think from a technical analysis perspective, that LMAT chart I like better. I feel like it's been more consistent, hasn't had as many oopsies along the way. So I really like the chart of LMAT more than X-ray. On the fundamental front, you also have a better, well, and again, there's the asterisk on the PE ratio. Honestly, when I look at the fundamentals, now I'm just making something up to make it sound good. So I'll pass on that and just go with the chart. I like the LMAT chart better than X-ray. So buying LMAT, selling X-ray, holding Abbott.
Buying Abbott, or no, excuse me, holding Abbott is, I think, the most sensible call out of all of these. So I'm with you on that one. I think Abbott is a hold for many different reasons. There's a reason why the company is where they are. I liked the way that you said that, Tyler. They've had great growth over the course of the last decade. They've got, a P ratio that's at 34. You elevated P ratios across many in the market right now. Forward PE ratio at 23, but they've got the history. They've got the consistency. They pay the better dividend. They have been increasing sales year over year for the better part of a decade, by the way. That's part of the reason why the company has been improving so well. And those EPS numbers have improved for the same consecutive years as well. I'm a hold on Abbott. I think that to me is the common sense call. Then it comes back to LMAT and X-ray. And this is a tougher one here. And go back to the charts, because part of this obviously is going to be in the charts, and stay on the monthly or the weekly and give me a quick look at X-ray again, if you can. I do not mind this weekly chart, although it's a volatile mess on the monthly. Back it into the weekly a little bit and see a little bit of a retracement on that weekly. Really big trend post-pandemic. It's made a huge comeback, obviously, like many companies in the market. It recently hit an all-time high and a new yearly high just about a month and a half ago. Retracement, violated all resistance. I'm not saying it's clean. Don't get me wrong. But I also look at a company that is 14 times the size of the other one. If I look at LMAT, and I'm thinking about just the nature of market cap and this one blasting off, and I got to chase it up here, I'm dumping LMAT. I'm not chasing the price action on a company that I'm not comfortable with. And I think the retracement on X-ray gives me enough interest to kind of lean there with the more, by the way, historically a stable company selling medical devices to dentists. So it's not like they've had up and downs all the time. They had a dip in 2020, and it does make sense to me. So I'm going to buy X-ray, dump LMAT, and hold Abbott. That's my choice. And Maddie, I know you had to step away, but what you probably heard maybe the end of that. What's your thought in our logic here? And do you have anything you want to add to this conversation?
I don't want to do the buy hold dump because I wasn't here for Greg's discussion on it. So but no, I've enjoyed the conversation.
Greg, what did we get right? What did we get wrong based on your opinion? I'll still hold to mine, but what do you see?
Yeah, you know what? We're closer this week than you think there, Tim. So just for different reasons. Abbott, I agree with you across the board. That thing's a juggernaut. I've owned that many times over the last decade or so. They're solid. They're not going to blow your doors off with a dividend yield, but they are very consistent. And when you start looking at fundamental and you start looking at longer term investments, things like that, consistency is a big deal. So definitely holding Abbott Laboratory. That leaves us the other two. Now I kind of held out on you guys a little bit. I don't know if it would matter to you, but it matters to me. From the LMAT perspective, I think it's overcooked, technically speaking. I'm not really fond of paying that high a price. Just from that perspective, it's run a long way. Obviously, if it pulled back to a certain spot, that would change my analysis. The thing for me is X-ray. So I dug a little bit deeper into X-ray, into their dividends. So on our sheet here, we have dividends of dividend increases of 9 years. If we go back and look at actually the dividends, they kept their dividend the same 2007, 8, and 9, I believe. So they didn't drop it, but they kept it the same. In that respect, that means they're over 20 years of not consecutive dividend increases because they didn't increase it, but without dropping it over a 20-year period, which I think is pretty fantastic. Then you look at it technically. I do like the pullback. I think there's an opportunity setting up here. Now, again, the dividend yield is not going to blow your doors off, But I do think that with their payout ratio only at 51%, they do have the ability to go a little bit further with that. They are a smaller company, but again, I think you made a good point in the fact that they probably got a core group of customers and things that they sell repeatedly to. So I do like that. I really like their sales numbers too. Like they got the highest growth this year. They've got a pretty good growth projection next year. So for me, I'm buying X-Ray, I'm dumping LMAT, and I'm keeping Abbott just for the consistency of it all.
Fair enough, my friend. Well, as always, part of the fun and the logic is the logic behind why we do what we do. And I appreciate you bringing three kind of different type of companies within the same sector. It made it a little bit more challenging here today, but fun game as always. Greg, appreciate you. Tyler, back on the S&P as we start wrapping up our show here today on a Thursday, 6/17/2021, day after the Fed announcement. Market's trying to digest it. Tyler, final thoughts from you, sir. What are you seeing here in the market? Message for the team.
Hey, we're green. All that nonsense we talked about earlier about worrying about commodity stuff. It's okay. It's okay. We're back to green. The S&P doesn't tell you jack right now. I do like that it's green though. I like that the bounce is sticking. I like that the NASDAQ strength is sticking. We're at the high of the day right now. Not a bad time to close the show out here. I would like to see the Russell come back a little bit better, but yeah, I mean, the story of the day was the commodity bloodbath. I don't know that we got to revisit it, but I'm interested to see, like Matt said, giving it a day or two and seeing, what is the fallout here. If you still like the inflation trade, maybe you look at this as a gift and you say, you idiots selling these commodities, I'm going to buy them hand over fist. Yeah, maybe so. I mean, there's your dip. You got one. So take advantage of it if you want to.
I'm not catching a falling knife. Somebody else can try to do that today. I'm going to give it some time to be
I'm not necessarily saying today.
Yeah. I know what you're saying, but I just wanted to clarify that. Greg, final thoughts there, sir.
Yeah, again, I got to go back to my original point. Some of this seems like an overshoot. The fact that the metals are just getting so destroyed just seems like an overreaction to me. I think you and Tyler are both right, and Matt as well, that you got to kind of let things cook. One of the things that I had to learn, as a trader over the last decade or so, is patience. Right? Let's let the market digest what's going on here. The rotation back into tech is a little bit promising if you happen to be, or not necessarily tech, but growth. If you happen to be, participating in that space, and that's good too. So just trade your plan and be patient. I think all things work themselves out. I don't believe that the inflation problem myself is solved just because Jay Powell said so. I don't think he's the Rock, or Stone Cold Steve Austin, I guess it is. But anyway, I just think you wait and see and let things play out. And I think there's going to be opportunities no matter what space you're in, whether you want to get into back into the commodities at some point, or whether you want to ride the tech wave for the next little while. That is not a bad idea either. So.
Okay. And Matt, final thoughts from you, sir.
Yeah, just kind of reiterate what you guys are talking about. I do think a lot of the price response, especially in the commodity market, is a little bit of an overshoot, an overreaction to belief more than data. And I do think we need to give the market a little bit of time here to really kind of understand what is actually transpiring from an inflationary situation. Because, guys, the market's been asleep for 3 consecutive weeks. 3 consecutive weeks. It woke up. It was a little groggy. Maybe let's let it get some coffee first. And so just give it some time is all I'm suggesting, to really see if the price response specifically in commodities and specifically in energy, because everything else is just a continuation of what we've already been seeing transpire in the market. Mm-hmm. What is new is the commodity sell-off. And so what I'm suggesting is give that commodity sell-off just a little bit of time to see if it actually is an overreaction, because I think it is.
Mm-hmm. I think prudence and patience is definitely the right mindset right now. All right, guys, that is our show. Appreciate you coaches as always, helping us analyze these markets one step at a time. Team Tackle out there, you guys are awesome. Love you so much. No question about that. If you are brand new to the channel, you're not done it yet, click that subscribe button, click the bell, come back and join us on a daily basis. Programming note tonight, we do have the Cash Flow Club at 6:30 Mountain, 8:30 p.m. Eastern. You can find that on the events page at Tackle Trading, and definitely that's going to be always an action-packed one. I believe Coach Gino is going to be there teaching that there tonight. We'll be back tomorrow with Coach Frank. He's going to bring some of his favorite chart setups, and we still, like we saw with NVIDIA, there's always going to be chart setups out there in the marketplace. We're going to break those down one step at a time. Have a wonderful rest of your Thursday here, Team Tackle. We'll see you guys tomorrow on the other side. We are out.